Gautam Chhaacharia, Head of India Research with UBS, joins us live from his Mumbai office. Gautam, good to have you back on ET Now. Thank you for joining us. Gautam, this market has been running on fumes and global liquidity, and it took only 60 minutes, little bit of selling by FIs and some concentrated selling in banks to crush the momentum. Are you a bit worried about the inability of Indian markets to scale up and stay above higher levels?
Yes and no, because fundamentally, in terms of where we are in the economic cycle, where the earnings are, market looks like to be more than fairly valued at the top, beyond the top end of our fundamental range for now at least. So in that sense, no. But yes, given the kind of support and liquidity infusion it has seen, the reaction in such a short period of time yesterday evening was a surprise to that extent. But again, just to step back a bit, in our view, the building blocks for economic cycle recovery are finally being put in place over the last 2 to 3 quarters. But the results of this will be seen not in the next couple of months or next couple of quarters, but will take longer because we're talking about an investment cycle recovery, not really a consumption recovery, which takes much longer. But finally, the building blocks are being put in place. So from a longer-term investor point of view, things are kind of looking to bottom out here, and some signs of the right steps being taken. But it's a question of also at what price you enter the markets, because if you want to make absolute returns, your entry price also becomes relevant. And on that, we have been highlighting that from a risk-reward perspective, 5500 Nifty and below is what makes the absolute entry levels attractive. So at these levels, what we've been telling investors is even if you believe in things coming back and having a gradual recovery, the risk reward is not attractive to buy here at these levels, even from a 6-month perspective.
Gautam, given the way that we've seen some, a distinct slowdown in FI activity as well. Yesterday we had a cash bar figure of a meager $12 million. Domestics have been pressing sales in any case. Do you think it's just a matter of time we could head back to that 5,500 mark, or is it going to take a while to come?
So again, there are two ways to look at it. One is obviously the global macro and liquidity part, which is difficult to predict, specifically given all kinds of scenarios being built around tapering, etc. But from a local perspective, the two big drivers would be the elections, the 8th December results. So a part of the market move is kind of factoring in a positive result scenario. So if is there any disappointment, then you could see some scale back in the market. The second is the hard economic data. The first couple of months, or basically September, October, November data, were kind of the expected cyclical rebound, primarily on the trade side, which has helped IP data also, and some sentiment positive being around monsoons also. But the hard reality is we are in a slowing down phase, and a part of the economic cycle correction or economic imbalance correction is linked to fiscal deficit consolidation or fiscal deficit coming down, and that's what the government is doing. And as we've seen earlier in the year, and we will continue to see ahead, fiscal consolidation typically dampens growth. And this will continue to be a theme for the next couple of quarters, where we see the growth numbers being dampened by fiscal consolidation. And we've seen the government continuing to come out and stick to its fiscal deficit target, something which we have also believed in and highlighted. So that reality of weak economic activity will also start hitting market sentiment and estimates over the next couple of quarters. So yes, markets are likely to come off from current levels. 5,500 or not, it's difficult to say in terms of absolute levels.
So give me an attractive PE band or a PE range in which one should invest, because there is no point in talking about levels. Levels, they keep on changing as earnings expand or earnings contract.
Yeah. So PE band, which we always recommend investors to work around, is 12 to 14 times for a market like India at this stage of the cycle. If it starts touching around 12 and a half times, then it becomes attractive to make bets. And we're talking about the overall market, but again, as we all know, Indian market has been clearly a story of two parts. One part being very, very expensive, doing well. The other part being cheap and not doing well in terms of numbers. So when we're trying to bet on the second part, which is the weaker part or the cheaper cyclical part, even that becomes critical when in terms of market level. So the overall market, when it comes down to 12 times, 12 and a half times, and therefore becomes more attractive, at that level, it does make sense to get into cyclicals and the cheaper part of the market.
What really seems to be spooking the banking space?
Banking is the kind of the leader in the beta pack for the markets right now. So if the market's correct or profit taking, or even at the futures level that there is selling the markets, then banks clearly lead the way. So it's a reflection of the overall market direction. Apart from that, the only thing I can think of what's spooking the banking space is the yields going up, the 10-year yields going up. So that's caused some concern from a short-term trading point of view among bank investors.
Yields going up, inflation not coming down. Is the market already pricing in a rate hike by the RBI next month?
Possibly. So part of the market is starting to look at whether it's priced in or not, there are multiple factors, but that's something which is kind of well talked about in the market among investors. So to that extent, a rate hike may not be a big surprise as such. But whether bank stocks are pricing in that, in terms of estimates, in terms of valuation, that's always debatable.
Gautam, technology certainly has fueled the market rally this year, but post numbers, with the exception of Infosys, other IT stocks are looking slightly ruffled. Is the risk-reward ratio not favorable in buying into IT stocks now?
We don't agree with that view. In terms of having been slightly weak or not having the same momentum, it's also a reflection of the recent move up in the markets being more driven by local hopes around elections as well as recovery. In which case there is some rotation away from the earlier leaders like IT, etc., away into more cyclicals like banks, etc. But in our view, the risk reward is still attractive, and both because of cyclical and structural factors. So cyclically, next year, 2014, could be one of the big years for budgets to increase, and that could be a positive surprise yet in terms of the sector. Structurally, again, because the margins have been reset towards the lower 20% range, that does provide an opportunity for a lot of these companies to target the infrastructure and the BPO space more aggressively, which is a far bigger space than the traditional application development space. So that could provide a lot more visibility on growth beyond next year, as companies are able to capture that opportunity and show delivery on that. And that could support valuation multiples at current levels or even re-rating. Again, point to highlight here is that if you look at even past episodes of the sector doing well, and obviously ignoring the tech bubble era, and you look at the past multiples for this sector, there's still some room for a lot of these companies to re-rate, even though they have done well.
Well, watch out for HCL Technologies. The stock is currently holding out in trade. It's been trading at a 12 times FY15 EPS, implying that it is still sitting at a good 36% discount to TCS and a good 25% to Infosys. Gautam, would HCL Technologies be a buy for you, purely on the valuation basis? And if IT continues to lead, there is further amount of headroom that HCL has to catch up with Infi and TCS.
So within the IT space, we actually prefer TCS and Infosys more than HCL Tech. HCL Tech, in fact, we have a neutral right now. And the reason for that is from the next 6-month perspective, the cyclical upside benefits will be much more for Infosys and TCS, given their product mix and geography mix than HCL Tech, because HCL Tech has a big part from infrastructure, which is not really the cyclical beneficiary over the next couple of quarters. So in fact, in terms of growth, you could see TCS and Infosys possibly benefiting more from the cyclical side, and therefore those stocks doing better. Infosys has caught up in terms of rating multiples and versus HCL Tech, and that trend is likely to continue in our view.
Right. There's a news flash, and Reuters seems to be indicating that Reserve Bank of India is once again a seller in the market, and they're selling dollars in order to stem the rupee volatility. So where is the rupee? 62.86. In general, there is a bit of mean reversion which is there in emerging market currencies, because the dollar index once again has spooked up to 81. As a group, the big outlier today has to be the entire tire space. That group has done exceptionally well. So CEAT, MRF, JK Tires and Apollo Tires, all of them are sitting at a multi-year high. And flip SEAT around, you'll be surprised with the price action here. About a month ago, it was at 140, and from 140 to levels of 260, it's been a one-way right, a one-way street for SEAT. Gautam, but the stock which I want to discuss with you, where you have a coverage, is JP Associates. The stock is at about 50, not even 50, 45, and you have a price target of 71. What is fueling this kind of optimism about JP Associates? Because even though they've sold one asset, the debt problems are not over.
Yeah. So JP Associates has always appeared a value stock if you look at the asset valuation, but it's an issue of how to monetize those assets and how those assets will be viable in terms of cash flows, not in terms of underlying value over the longer term, but in the interim whether they have the cash flows to make them viable and even at the extent of surviving in some form. So the value is always there in terms of the assets. So it's a question of what value the market ascribes. So at the lower end, market was not willing to ascribe assets value to a lot of its assets, with some visibility on asset sales. Again, they're very small, but at least the willingness is there from the management. It shows that the management will be willing to sacrifice some assets if it's required in the extreme case of survival. So that does bring in a lot more confidence around the valuation of the assets, and that's the reason why we have that kind of price target for the stock.
Gautam, does Jet Airways become attracted now with the deal being sealed with Etihad, or a part of the story is already done with now?
No, we don't cover the stocks, can't comment on that.
Let's look at Reliance Infra. You have a price target of 535 rupees. Most of the cyclical stocks are up by about 15 to 25% from the recent lows. Why do you still like Reliance Infra? Because it's too early to make a case that earnings have revived for that sector or for that company.
So again, in a way, it becomes similar to JPA. This is a question of asset value and the cash it has, etc. So on that basis, it is looking attractive and cheap at current levels, and our price target is backed by that asset valuation basis. But yes, what you are saying is about more cyclical earnings upgrade cycle. That's definitely some time away. We're not building that case in. So what we're looking at is if confidence returns around economy bottoming out, confidence returns about viability of the existing assets, etc. over the medium term, then markets will be willing to give more value to the existing assets. So it's not necessarily just about a cyclical uptick in earnings.
So Gautam, from last 3 years, those who bought defensives, those who bought brand, consumer names, brand owners, they've made money. Do you think that story is unlikely to continue, and it's now time to go down the ladder? It's time now to treasure hunt in some cyclicals and maybe revisit some asset owners and companies which are sitting on a lot of hard assets?
I would think so, but again, depends on the time frame of investors. If investors are looking at a time frame of next 6 months to 1 year, it might still be a bit early, but it's a good time to start looking at them, but it might still be a bit early. But if you're looking at from a next 2-3 year perspective, then definitely this is a good time to start taking those bets, because as I said in the beginning, finally over the last 2-3 quarters, the building blocks are being put in place for a recovery, and this recovery will take long. It won't be a quick V-cycle kind of recovery. It will be a grind recovery. But these are the times when you want to start looking at those clearly.
Gautam, what is it that you like out of the auto space? Tata Motors has had a good ride of late. There's news out in Bajaj Auto as well, them tying up with KTM, upping production. What is it that you prefer?
We still prefer Tata Motors as a top pick. Apart from that, we do like Maruti. We are in fact negative on the two-wheelers, both because of the expectations, the earnings estimates, and the valuations where they are. So they have had a good run. We downgraded the sector, the two-wheeler sector recently, about a couple of months back. So that's not a space which we would recommend investors. So Tata Motors is the top pick, maybe a Maruti.
What is new about Tata Motors? Because for a stock to keep on going up, it needs triggers, it needs constant good news. JLR is a success story, but JLR is also an old story.
Yeah. So that's true. That's true. So from a near-term perspective, again, highlighting any particular catalyst or trigger will be difficult. So it still remains whether they can keep on surprising on the sales data, etc. But we don't see any reason for cutting our view on the stock, simply because both on the earnings estimates part, we are fairly comfortable. We don't think the street is overestimating the earnings over the next couple of years. And secondly, valuations, I think there's still some room for valuations to move up. It's no longer as cheap and attractive as it was a year back, but there is still some room for it to go up from a valuation perspective also.
So Gautam, if IT emerged as the clear turnaround story for the year 2013, what could be the turnaround story or turnaround stock or sector for 2014?
We still haven't formalized that view, so we'll come back soon to you on that.
But if a client walks up to you, if you insist on a multi-bagger idea, you could address that query, and you could address that query right now. You can't be telling a client that, look, I don't have a view.
Yeah, no. So as of now, we're still preferring from a portfolio perspective. We are recommending IT, telecom, media as the top picks, selective oil and gas names, selective auto names like Tata Motors, and from a consumer space, more the rural focused staples rather than the discretionary names.
Still hot on Sun TV because there is definitely some degree of volatility in Sun TV's performance.
It will be volatile for a while, but yes, we still like the name.
What about telecom? Is Bharti the top bet there?
Yeah, at these levels, clearly Bharti is the top bet because Idea has had a good run, and from a relative positioning point of view, Bharti is the top. But also to remember the fact that from the bigger worry which was there for Bharti recently was around the currency part. Now with currency also stabilizing, even that overhang should go away. And thus from a relative perspective also, Bharti looks a better bet for us.
Gautam, with you, we always focus on what to buy, what to add. Give me a stock where you think valuations are looking slightly stretched and a 10 to 15% downside cannot be ruled out.
Hero Motors for us.
Okay, are you confident? Because valuations are not that stretched. It is still trading at a minor discount to Bajaj Auto.
It is, but compared to its own historical band and given where the estimates market expectations are, there is room for it to disappoint.
Gautam, really good chatting with you. Appreciate you taking the time out and speaking with us.